Okay, so thanks. Welcome back. Today, again, this is the second part of our series on of looking at the Bernanke report. In part one, I made a few mistakes, which I want to talk about and correct today. So first thing, I said that the Bernanke report came out last summer. Untrue. It came out in April of uh, of last year, which means that it's actually the 1 year anniversary of receiving the report and so on. And so we want to provide a bit of an assessment about not only what Bernanke said, but how the Bank of England is responding to this. So that's the first thing. Second thing is in our trademark slide. I had this parentheses where I talked about in the third bullet, what do policy instruments need to do to achieve inflation and other objectives? What we typically mean by that is the interest rate path. Okay, that basically when central banks have these fixed action dates, that those periods are an opportunity for the central bank to explain what monetary policy is. Okay, and what monetary policy is a commitment to adjust the policy rate today, which again last week we said is irrelevant for almost all actors in the economy. What's relevant for people in the economy is the expected path of the policy rate, because that's that expected path that influences longer term interest rates and the exchange rate and so on. So that's what we call AFPass central banks. They have to have these three assumptions, and the Bank of England, the Bank of Japan, the ECB, have yet to develop an FPass Mark One framework. Now, I want to get into some of the details because we have Martin here, who worked for many years at NISR and so on. And I'm sure he has a perspective on modeling because of that. So I want to talk a little bit about the history of modeling at the Bank of England, as well as other central banks that I have worked with around the world and so on. But maybe, Martin, you could remind us what years, or remind the audience, what years were you on the MPC at the
I
Bank of
was on
England?
the MPC from 2000 and from 2010 to 2016.
Okay, 2010. So that very interesting times. Global financial crisis was really 2000, started in September 15th of 2008, but you were still there during the European debt crisis, some very interesting challenges that I'm sure the audience will enjoy listening to. I want to also, before we get into that, talk about um, another little mistake I made last week. I said Bank of England spends 50 million pounds a year on monetary policy. Okay, and I was referring to a table that is measured in U.S. dollars. uh, so I wanted to correct that. If you look at the table for last year, you can see that monetary policy was 44 million pounds. Okay, which is approximately 50 million U.S. dollars. But uh, so I'm very interested to see what the number for 2025 is and so on. Martin last week said that the jury is still out about what the cost of not having an FPass framework is. Uh, when we looked at this question in our uh, 2018 book, so this is a book we published at the IMF, editors, Tobias Adrian, Maury Osfeldt, and I, we took stock of the experiences of what were known at the time as these AFPass Mark One central banks. In other words, these central banks that could address these three essential ingredients. And what we found is that they did better. Like really good examples would be during that period when you were at the Bank of England, for example, Martin, during the European debt crisis, the ECB and the Bank of Japan were clearly in low inflation traps. So what I mean by that is that their economies were weak, and it would have been a no-brainer to find some policy instrument to try to raise inflation up to the target and raise long-term inflation expectations, more importantly, up to the target, and to stimulate the economy. And the euro area, for example, would be a really good example of a central bank that failed to do that. Long-term inflation expectations only got up to about 1.5%. Okay, so they weren't able to achieve what the Fed had achieved, which is to stimulate the economy enough with monetary and fiscal policy to get long-term inflation expectations pretty well anchored to the target. So there was, in the case of the euro area, there was still a half a percentage point gap, and that was problematic because they actually entered COVID where the interest rate was still at the effective lower bound, and so when they faced those initial shocks in COVID that were contractionary, they had less policy space to deal with it than the US did. And as a result of that, you can read this in our paper that's going to be published in Oxford Economic Policy. Because of not having the framework, because of a lack of credibility that the central bank was capable of delivering inflation on average, when the Fed employed, along with expansionary fiscal, when the Fed employed those expansionary policies during COVID, and of course Europe couldn't because they didn't have as much policy space as the U.S. The
Could
U.S.
I just,
dollar depreciated by 10% and so
yes, could
on.
I just say something on that,
Yeah,
please? You
please, please,
referred
please,
to
please.
you referred to expansionary fiscal policy in the United States, which, of course, the euro area countries, or at least the framework for the euro area countries, was designed to prevent being used on a fine-tuning basis with the debt and deficit limit, notwithstanding that neither was tightly imposed, and how far the difference was the fiscal policy difference, how far it was the monetary policy framework, I'm certainly not sure.
In fact, I don't even care because it's really both of them that matter. At the end of the day, U.S. Employed very aggressive policies. When you are concerned about the effective lower bound, there is a very important principle that needs to be followed, and that is that fiscal policy has to backstop monetary policy. So when the ECB and other central banks, when they're constrained, there is always a fear of Fisherian deflation. Like during the Great Depression and so on. And when that happens, you have to have a stable monetary policy framework. You have to have fiscal policy backstopping monetary policy. So, um, maybe distinguishing between monetary and fiscal is always difficult, sometimes even impossible. But in this case, it doesn't really matter very much for the question that I'm interested in, which is that the lack of a framework in the euro area meant that they were at the effective lower bound going into it because they had solved the problem, and as a result, and you're absolutely right. I mean, the fiscal rules that they had developed. Well, the problem with Europe is not just the fiscal rules in the individual countries. they don't have a fiscal union. You can't really have a fiscal union unless you have a political union. This is the very fundamental problem of Europe and how it's always going to be one shock away from an existential crisis and so on. So yeah, I understand that it's difficult to distinguish between those two things, but for the question I'm interested in here, it doesn't matter how much is monetary and how much is fiscal, right?
Well, it doesn't. It doesn't. If you're saying, could Europe have, or the EU, the euro area, done more during the period when it was, because of its framework, fiscally constrained, that's a different question from saying, could it have done more without the presence of the fiscal constraint?
Yeah. I think what I'm saying and actually is explained very clearly in this third paper that's really, really important for I think people to look at. So this is called Macroeconomic Management when policy space is constrained. The book on the left is about AFPass Mark one regimes, taking stock of them in 2018. The one in the middle is about these issues that Martin and I are talking about. So it talks about what do you need to do in periods like the European debt crisis and so on, when there's a perception that policy might be constrained, but in particularly in places where you have monetary unions that don't have fiscal backstops. And of course, if you run into the effective lower bound, and there's a perception that policy space is constrained, then you face this risk of getting stuck in a low inflation trap or worse yet, deflation and so on. But um, did that do we need to go further on these issues because there's some other things that I wanted to cover as well. But
No, let's
uh,
go on. Let's go on, please.
okay, so then Martin said that that the jury was still out regarding whether or not we are observing um, whether or not these non-AFPass frameworks were, is there an ironclad case that there are big costs from having non-AFPass frameworks, from not developing it? And so what I want to do is I want to go through some of the data. So first of all, I agree with him. Okay, when you're evaluating monetary policy regimes to make definitive and conclusive statements and so on, you require large samples, and you need to be able to compare central banks that were successful versus central banks that were unsuccessful, facing similar kinds of issues. So, in the case of the euro area that I referred to earlier, for example, where they got stuck in a low inflation trap, I contrast it with the Czech National Bank that pursued an FX intervention strategy and an overshooting strategy. And of course it was successful in getting inflation up so that when it entered COVID, it had more policy space. So that's an example. And we're looking for, as many examples as possible. I'm going to look at the data, some of the data for the United Kingdom today, and tell people that on the basis of my assessment, I think there are real problems. I don't think that they've won the war against inflation. I think inflation expectations are are significantly higher than what their target is. I think their analytical framework is extremely weak. Okay, and I'll explain. I'll try to explain that a little bit here. Uh, so what we're looking at is, and I'd like to get Martin's comments on this, but what we're looking at here is a scenario that the Bank of England produces in their monetary policy report. I don't know when they started producing it. Actually asked Susie uh, to go back in history, but Martin probably actually knows what the answer is, and so on. It's a chart that is based on a constant interest rate. Okay, and it's a chart that was during COVID when the Bank of England was projecting that inflation was going to rise into the double digits. Okay. Now, interestingly enough, in the scenario, even though the policy rate is uh, is fixed at 2%, inflation gradually, but it converges back to the target. Now, in an AFPass central bank, there are six principles of flexible inflation targeting. One of them is that the fundamental role of the central bank is to adjust the instrument sufficiently aggressively to provide an anchor for inflation and inflation expectations. What that has meant is that in all of the design of our FPAS central banks, this chart is illegal. Like you shouldn't be able to generate a chart that looks like this with constant interest rates. And the basic logic, goes back a very long time. I'll go back to Milton Friedman's presidential address in 1968, where he explained the logic of the expectation augmented Phillips curve, and he basically said, "Look, you cannot think about pegging the interest rate." And the exact argument that he gave was that imagine that you were in an inflationary world like COVID, and you tried to peg the interest rate. Well, obviously, if the interest rate, let's use this example that's on the screen, was 2%, and people were expecting double digit inflation in the future, that would mean that the real interest rate, which is the nominal interest rate minus inflation expected in the future, that real interest rate would be very negative. Okay. And the argument would be that in virtually any model, the real interest rate enters the aggregate demand equation. The idea being that if real interest rates are really, really low, and if people expect prices are going to be really, really, really high in the future, that demand for goods and services would be high today. So that's your standard formulation of the aggregate demand function. So obviously there's going to be an instability because if you try to create a scenario in a model that has that principle inside of it, there will not be an anchor for inflation and inflation expectations in that model. And so that's why when we write down all the models for FPass Mark 1 and FPass Mark 2, it is impossible to solve them with constant interest rates. Okay, so this this is a problem because it demonstrates kind of a lack of understanding of modeling, or it might have something to do with how the models are actually used and so on inside of the Bank of England. Now, my understanding, when I look at the compass model, that compass model should have the restrictions that you can't do this.
Could I
I don't
say,
know. I
could
don't
I
know about
say
the
how I
earlier
think this,
models. So
could I say how I think this, well, something both on the history of the simulation and how I think it's
please,
working? So, as to the history of it, when the Monetary Policy Committee was set up in 1997, Mervyn King was concerned that actually future interest rates mattered as well as the current interest rate. On the other hand, the structure was set up, with the members taking individual responsibility, and the solution he adopted was to ask them what what interest rate, if held constant, would deliver, would bring inflation to target in between 2 and 3 years. Now, that of course raises the question, what on earth is going on beyond the 2 to 3 years? And how I think this is stabilised is that beyond the 3 year horizon, there's an active policy rule which is bringing inflation to target, and that's why the inflation target appears to be operating a stabilising influence during this simulation. Now, that's the history of it. At the time and in the couple of years afterwards, people said they wanted to know what would happen to inflation if interest rates followed the market trajectory instead of the constant path. The constant path, as a consequence, was gradually downgraded, and more emphasis was put on the market interest rate path. Now, I agree with you that that has the same problem, that it's a fixed path, even if it's a fixed non-constant path. And once again, as far as I could understand, the stabilisation was done by what was happening beyond the end of the 3 years.
That is very, very helpful because I think the problems at the Bank of England right now are very much related to mistakes that they made in the past, okay, that then create a history that and a culture and processes and so on that that are still haunting them. Uh, how how did Mervyn King argue? It makes absolutely no sense to me. In fact, I wrote a paper on this on the Bank of England, this stuff, but it makes absolutely no sense to me. Why would you consider a question if we were to raise the policy rate today and keep it constant, and then make an assumption because expectations wouldn't be anchored in that world, that at the end of the simulation that we assume that people are going to then adjust the reaction, and that's going to be the thing that's going to be involved in the calculations of our expectations to keep this thing pinned down. How does that make any sense whatsoever? How did he sell that? Because it seems completely nonsense to me.
Well, no, I don't know what was going through Mervyn's mind at that point. My guess is that it was an attempt to resolve the problem that the committee voted only on current interest rates, whereas the future path also mattered. So he focused on picking up the near-term future path and the long-term future
Right.
path, which
Yeah,
also matters, was beyond the end of the horizon. Now,
but
I'm certainly not saying that that was a good idea, but that I think is the origin of it.
but then the origin of the problem is like your defense of it is because they're voting on these things. Okay, there's no was there did in the direction in the creation of the monetary policy report was a law that they had to because you're arguing that because they had to vote on the policy rate today, okay, and because they found it kind of impossible to vote on that in the future, why do you think that you have to vote on all that stuff?
Well,
That's just taking it
I
one level
mean,
deeper.
that may be true, but it would require primary legislation to change that, because the law is that the committee does vote on it.
Vote on the current policy rate, but that doesn't necessarily mean that they have to vote on all future paths of the policy rate.
No,
The
I
law
agree
doesn't
with
say
you.
that.
I agree with you. It doesn't, but no, if the committee was expected to endorse something, as I say, as I have said, I think one resolution might be for the staff components of the forecast to show a profile which they think is consistent with the inflation profile, and that would retain the MPC responsibility for the inflation forecast, the growth forecast, and the unemployment, but it would also give an idea of where the staff thought interest rates needed to go in the future.
See, I'm very confused here because I'm trying to understand what the legal uh, situation is here. Are you saying that there's something about the legal framework that that forced them into doing something that makes no sense whatsoever? Because I don't think that's true. They they might have to forecast on they might have to um, vote on the current policy rate,
Which they do. I mean,
which
they
they
do
do,
have to vote.
like
They do
everybody
have
else
to vote
does,
on
but
that, yes.
like virtually everybody else does that as a committee. There's nothing
Yes,
special there. But everybody else doesn't fall into the trap. They have a coherent framework because the problem with the Lombardelli thing now is that somehow she thinks that if they produce alternative scenarios, they're going to become lightning rods. And it's almost like, the logic of the MPC having to vote on everything. That is why they might become lightning rods, especially if they didn't make any sense, and so on. And so the way that this is done under an FPass Mark II scenario, you still have people voting on the policy rate, but you have a coherent framework, okay, that asks where is the economy today? What are the underlying forces, and what do I need to do with my instruments to achieve my objectives? And that's not just the policy rate today. It's about using the opportunity to set the policy rate today and to communicate how they view the economy as individuals. And I know, you could say, well, that comes out in the Bank of England minutes and speeches and so on, and that's totally okay. But what we're talking about here is how do you create a coherent framework? How many central banks have created a coherent framework? How the Central Bank of Armenia, this book on the right, is what they did in 15 months uh, by but of course building off of the FPass Mark One framework. But yeah, so what we're talking is having a coherent framework, and then the question is, does it matter? And this is where you left off at the end of part one. So I wanted to kind of go through that a little bit. But so I think the answer is we both agree that this approach of doing it is very problematic. Okay, because if it is done as you describe it, it means that the staff are putting in an assumption that expectations are anchored in a situation where we would dispute that expectations are anchored. In other words, if you kept the policy rate at 2% over the projection of rising, and you were in an environment where inflation was really, really high, it would simply make absolutely no sense whatsoever to assume that inflation would gradually converge back to the target. And the other thing too is that's not transparent. You can't see that in the MPR about what specifically the assumptions are for expectations in these simulations. So do you agree with that?
I agree that it's not transparent, that the issue of, even if you regard the explanation of what's done during the period of the projection shown, there's nothing about what's done after the end of the period shown, which, as I say, I think is where there's a monetary policy rule that's active, and that's what anchors the expectations.
I'm going further. I'm saying it's not just a problem with transparency. It's just wrong. It's just, it's not inconsistent. It's not consistent with how we explain what monetary policy is, which is a commitment to adjust the interest rate sufficiently aggressively to anchor inflation and inflation expectations. When we produce this book, okay, that whole framework, FS Mark II, in 15 months, we had weekly discussions with a lot of world famous economists, the best of the best that had been involved in creating these monetary policy frameworks and so on, and got feedback from them. And the overwhelming consensus, the thing that everybody agreed on, is that even though Taylor rules and things like that are extremely problematic, that's why we have things like objective functions now for creating scenarios. But even though everybody agreed with all the practical problems with implementing, everybody agreed that's what monetary policy is. Okay, and that needed to be incorporated into the design of anything that we do. So I I think it's far more problematic than just not being very transparent. It, you're showing a scenario to people where that simply doesn't make any sense. That Milton Friedman was trying to point out in 1968. It's just a wrong way to think about monetary policy and managing people's inflation expectations by demonstrating what you need to do to bring inflation back to the target. Yeah, Susie, please.
Yeah, I just wanted to intervene a little bit. Like first of all, it's always great to see you both, like great minds to discuss a very interesting story about how do we actually our perceptions on the monetary policy framework and etc. So I would really want to ask if you are actually voting for the projections of the CPI inflation, that's how they are going to converge to our target. How do we make sure that based on some uncertainties and maybe some external shocks, this is the exact projection that we want to have?
Well, the answer as to what about external shocks and so on, these forecasts are produced conditional on, assumed paths for the exogenous variables. Now, they may turn out, no, the exogenous variables may turn out differently, and the width of the fan chart is meant to represent the uncertainty that the committee thinks the forecast faces, and that when I was on the committee, very little time was devoted to discussing the parameters of the dispersion. But I think what is generally true is that that's based on experience of past shocks.
Yeah,
With
and
that, is I would have absolutely no idea how a group of how many people on the MPC?
9.
I have no idea how 9 people would would try to construct a forecast of the inflation and the economy because it has for it to make sense. They got to have a complete picture, and so I just I would have no idea how anybody could do that in a way that made sense. And the idea of just trying to get people to do that, in my mind, just doesn't make any sense. At the end of the day, somebody's going to have to be in charge to impose some macroeconomic consistency on it. Uh, plus they must waste enormous amounts of time trying to do that when that time could be used to trying to develop different views about how the economy might work and different assumptions about what all those exogenous variables are. So just to be clear, this is probably one of the reasons why inefficiency is so high at the Bank of England, but it also clearly shows why transparency is very low at the Bank of England, as you can see in the chart. This is after we wrote the book, or around the same time we were writing the book at IMF, we developed a better transparency index so that you could more clearly distinguish between AFPass central banks and non-AFPass central banks. And so those gold things in the charts are trying to give credit to those central banks that believe in transparency. I think the way to describe the Bank of England framework is that it's not only non-transparent, but it's patently non-transparent, the way that they uh, produce these things. But it's worse than that. I would argue that it not only just wastes resources, but it takes the attention off things that people should be looking at. I want to shift to the to where we ended last week, where Martin said that the jury is still out about whether or not non-AFPass central banks like the Bank of England are doing worse than AFPass central banks. Now, this is a chart on inflation expectations because obviously that's very much a key variable, that we're talking about here. If you go back to May of 1997, it's very interesting to understand what happened there. And I've written about this. It's summarized in the book that I was referring to, the 2018 book, but it also showed up in a Weale chapter where Nicoletta Bettini and I had basically surveyed all the central banks, AFPass, non-AFPass central banks. This was way before 2018, in the early 2000s, and so on. But one of the things that we looked at was the experiences of the early IT central banks. So, what was strange about the UK case is that they had adopted inflation targeting, I think in 1992, but it was a very strange form of inflation targeting because the Bank of England actually wasn't even governing monetary policy. The Chancellor of the Exchequer was. And if you looked at measures of long-term inflation expectations, so if you looked at, for example, 10-year break-evens, or what we call 10-year break-evens today, they never used that terminology back then, but when you looked at what inflation expectations from the bond markets, so this is by comparing the yields on conventional bonds with the yields on index bonds. When you looked at that number was always at the upper end or above the upper end of the range of the inflation targets in the UK, even up to 1996. So if you look at other countries, Bank of Canada, you look at Reserve Bank of New Zealand, you look at many other countries that had independent monetary policies, their long-term inflation expectations started to anchor faster, whereas the UK still had this humongous credibility gap. And that people thought correctly at the time. At that point, Martin, the jury would have still been out. But people's judgment, I believe it, the Chancellor of the Exchequer, perhaps in people at the Bank of England said, well, geez, we're paying these really high long-term interest rates. They embody long-term inflation expectations that are much higher than the midpoint of our target range. And in fact, they only come down to the upper band once in a while. They realized that it made sense to change the fundamentals and to give the central bank, the Bank of England, instrument independence, to create the Monetary Policy Committee, and wisely, again, the jury would have still been out, but they I think, made the right decision of moving from a range target to a point target. Now, subsequent to that, I think point targets were clearly found out based on a much larger set of data and experiences of many, many countries to be much better because they provided a focal point for expectations. What happened? Well, on the day in May of 1997, when they announced this policy, this is very important because they changed the fundamentals, surprised the markets. On that day, long-term inflation expectations fell significantly. And within 9 months, they became anchored to the target, and they stayed that way. There was tremendous amount of amazing research by Andy Levin and co-authors at the Fed showing that period, not only for the UK but also for Sweden and Canada and places like that, Chile, that in those countries that had independent central banks, that they did better at anchoring long-term inflation expectations. In other words, their long-term inflation expectations moved around less in response to information that drives short-term inflation expectations. Unfortunately, that story um, did not last, and I argue that the lack of having this consistent framework eventually resulted in long-term inflation expectations ratcheting up even before COVID, and then ratcheting up once the stagflationary shocks of COVID existed. I do, I do understand that there are measurement issues that part of this measure of inflation expectations that have drifted up could be because of problems in the market. I am totally on board with that. Just as there are data problems with everything else that we're going to talk about here in a second, that one has to interpret these data, with a grain of salt and in combination with looking at other data. The Bank of England used to report these numbers, but has subsequent stopped reporting these numbers. So this is an example that was taken out of one of the monetary policy reports, again during COVID, where you could see that inflation expectations, in this case, they reported 5-year, 2-year, as well as the 5-year, 5-year. So what that means, the 5-year, 5-year would be starting in 5 years. What do you think inflation is going to be over the next 5 years? The 5-2 would be in after 5 years. What do you think it's going to be over the next 2 years? So this is kind of conceptually what you'd like inflation to be anchored to your target. And as you can see, it is much, much higher than the target. There's also another problem that you can see in the chart, and that is when you have a framework that says, where is the economy today? What are the underlying forces? And what do I need to do with my instruments to achieve your objectives? If you don't have that third thing, your monetary policy report is going to look like elevator economics, which you can see is a problem in the chart. Okay, because the story in the chart, if you had a AFPass central bank, would be that we're adjusting our policies and market expectations are consistent with our target, and so on. And you can see the elevator economics here. You see it all through the Bank of England monetary policy reports. Medium-term measures of inflation expectations have increased. You don't read anything about potential measurement errors and why they might be discounted. You don't read anything about what is the implication of this for thinking about monetary policy and so on. So, and they've stopped. They reported these measures of expectations from financial markets for years and years and years, and then all of a sudden, without making any comments on the issues, stopped publishing them and so on. So, but it's still the case today that if you look at measures of long-term inflation expectations, they're significantly above the target. And that the question then becomes, well, does that make sense? How does that corroborate with other information about what is going on in the economy? So now what we're going to do is look at the latest monetary policy report before I do that, I want to look at, again, data from the latest monetary policy report. And what I want to do is I want to look at service inflation. And so this, in the Bernanke report, you'll see that the Bank of England has big problems with data management and so on. So let me give you an example of the U.S. At both the Central Bank of Armenia and the National Bank of Georgia, we have created this concept called non-traded sticky price inflation. These ideas go back all the way to guys like Rudy Dornbush, who created like the overshooting model and so on. So the idea is that if the prices of goods and services and labor are sticky, then the exchange rate, and this is very important because to think about the exchange rate, you have to have this framework. In other words, you can't think about the exchange rate without thinking about the expected path of the policy rate. So in a world where you have sticky prices or sticky prices in wages, for example, that the exchange rate can act as a very important shock absorber, but that requires transparency about monetary policy so that financial markets uh, can develop a reasonable forecast or scenarios about what the expected path of the policy rate is and so on. Now, just uh, I agree that this is not definitive and can't be, but it sort of shows some of the other problems at the Bank of England and so on. In countries that have very advanced policy frameworks, that creates a demand for data and for data integrity and so on. So, for example, in the case of the United States, the Atlanta Fed produces what we call a measure of sticky price inflation. And they update this measure of sticky price inflation every month. So as soon as the CPI is released on that day, you get an update of this sticky price inflation. That measure of sticky price inflation, excluding food and energy, represents about 64% of the CPI. The U.S. doesn't focus enough on open economy stuff because, uh, but but on their website they provide all the individual items and their weights that go into that calculation, and that allows people like us in a couple of days to basically go through all those items and to ask, well, what goods are traded goods and what goods are non-traded goods. And so that allows us then to access the data and to update these series to adjust it to produce non-traded sticky price inflation. And why do we want to do that? We want to do that because when we think about putting monetary policy frameworks together, we want to think of providing an anchor for the stickiest prices in the economy and so on. So that you could think that if you had shocks, for example, like COVID, or you had shocks to energy prices or whatever, you want monetary policy to be providing an anchor for inflation and inflation expectations. And to do that, you need to define a price index that you think is more consistent with the notion of what sticky prices are. Typically, it's wages and a bunch of goods and services, haircuts. Haircut prices can be fixed for a long time. Rental prices, something that you fix typically for a year and so on. And so we did that in a couple of days in the case of the United States because we could go and look at some research that talked about how you would measure sticky prices, and you had access to data that you could get very, very quickly to adjust that. Tried the same thing for UK data. Good luck. Couldn't even get seasonally adjusted measures of service prices. So, in the case of the US, in the case of the United Kingdom, the best thing they have that would be an indicator of sticky prices would probably be service price inflation. This is taken from the latest monetary policy report. You can see that service price inflation is still well over 4% in the United Kingdom. And that, of course, is significantly higher than many other countries that started raising interest rates faster, in some cases a year earlier than the UK. So the UK, if you look at their path for the policy rate during COVID, they kind of moved it around the same time as the other advanced economies. So I would argue that in some cases was a lack of a framework. The Fed, yeah, they had a framework in 2021 that was AFPass Mark 2. All they would have had to say was, we think inflation's transitory, but we might be concerned that it's more persistent. And that would be the case B scenario that we talked about last time. Had they said that, financial markets then would have adjusted much faster because because they would have known that the Fed was concerned about that. So I think when I look at measures of inflation expectations from financial markets, looks to me like inflation is still well above target. Okay, it's only because they're looking at these headline measures of inflation that obviously went way up during COVID, as they should have, because of things like bottlenecks and stuff like that. But then, as those problems disappeared, things like core goods prices went way, way, way down. So way too much emphasis on looking at headline inflation, not having a forward-looking framework that clearly distinguished between things like non-traded sticky price inflation, which have clearly increased. Now, is that consistent with another price that we think is sticky in the economy, which is wages? And here we have, multiple measures, but if you look at the measures on the top, they are way higher. And this is related to what Martin said. Is this because they reflect inflation expectations that are higher than the target, or does it reflect relative wage resistance? In other words, are they still trying to recover some of the losses that they experienced during COVID and so on? Martin seemed to think that was a very important thing to distinguish between those two things. I think it's important to study that, but at the end of the day, if your judgment is that inflation expectations are a part of the story, you might be worried, because when one looks at the inflation premium built in service prices, if one looks at the measure of inflation expectations apparently built into some of these wage measures, if one looks at the inflation expectations that are embodied in financial markets, they all look pretty high to me. Now, that,
No, I
so
agree with you completely on that. That in particular, whatever the cause of the pay pressures, that no, the pay pressures are quite inconsistent with a 2% inflation target.
okay, good. I want to talk a little bit about modeling. Um, um, so in my mind, to go back to, I don't think we can wait for conclusive and definitive evidence. None of those FPass central banks had definitive or conclusive evidence when they set out on the journey, to develop these frameworks. Um, usually it was about because they believed that they needed to do the right thing, that monetary policy transparency was a very, very important. You can't really have accountability until you have transparency and so on. So I would agree with you that a year from now, if it turns out that wages, service price inflation, and the bond market all reflect 2% inflation, I will be the first person on the planet to say I was wrong. And I'll be recorded for everybody to see that I've completely changed my mind. But on my judgment, I think the UK fell behind the curve and has been systematically falling behind the curve. And part of the problem is, when I listen to the governor's remarks when he goes to parliament or just when he's giving speeches and everything, he's talking about stuff that's proximate causation of inflation. He's talking to farmers about food prices and stories about energy prices and stuff like that. And all that analysis, I agree is important, but at the end of the day, the central bank has to take responsibility for inflation, where inflation goes, by creating a framework, by communicating with financial markets that they're committed to doing that. So I want to talk a little bit about the models that they used at Bank of England. Um, and I have this impression and I'll tell you where I got this impression from. When I was teaching the Norges Bank this stuff, uh, David Hendry had this enormous influence on Norway. Like I would describe the whole place that the entire country had been Hendrified in the sense that all of academia, people in the central bank and blah, 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 everybody had been infected that you had to use this Hendry methodology and so on. And of course, a couple of them came to a workshop of mine, and I told them that the problems with that methodology, it has been a complete disaster and stuff. But then they told me a story, and their story was actually much better than my story because I was telling them stories um, about what could go wrong with it logically, and what they said is no, no, no. This is what the problem is. The entire research department of the Norges Bank had built one of these econometric models using this Hendry methodology. And they would go to the governor. And at that point, they had an inflation target. And the governor would be looking for advice about what does he need to do with his instruments to achieve his objectives. And they would show the governor a forecast where inflation would not converge to the target, but would converge to a higher number than the target. And the answer is the reason it would do that is that it was estimated over a sample where inflation was above the target. This is why they came up with inflation targeting, because they thought inflation was too high historically. But that methodology was producing a forecast that it was actually higher than the target. And the governor would look at them and say, why are you showing me this forecast? I need to have a forecast that tells me how to think about my instruments to get inflation to converge back to the target. So what happened at the Norges Bank? Well, I probably would have fired the ball because they should have known that well before they got into it. But instead, they got put in charge of modeling for financial stability, which is about as funny as anything you could imagine as an economist, because if you can't figure out how to model for monetary policy, how the heck would you do something as complicated as trying to think about financial stability issues? So then I provided them a plan, and they set off to implement that plan. Unfortunately, when we were teaching them, they seem to have missed the lecture because they also got into this DSGE stuff and so on. But the reason I relate this to what I was talking about with respect to David Hendry is that when I was at the Norges Bank, David Hendry had just arrived and was talking to his these research department guys, and he said, "The Bank of England has just rejected my methodology, and I'm here to tell you that they will be back." And that was kind of amusing because I was creating a completely different group where we completely ignored the research department because they had nothing to say about monetary policy, where we were building everything up from scratch. So was it the case that this Hendry methodology was was that the methodology that was being employed at the Bank of England? Because that is also could be related to some of these problems that I was referring to earlier, that they simply lacked a methodology for doing policy modeling. But could you talk a little bit, Martin? What do you know about modeling at the Bank of England, and how has it been potentially problematic in the areas that we've been speaking about?
Well, the model that I think is still in use is the so-called compass model, which is a form of general equilibrium model. The assumption that's made is that the policy target, the inflation target, is credible. And as a number of people have said, most notably Mervyn King, the simulations that were done using that model always showed inflation returning to target because of the simple assumption that the target was credible. Now, if you look at the period of the last 2 or 3 years, quite a lot of people have been saying, supposing the target loses credibility, and that wasn't built into the forecasts. And it was this assumption that the target was credible that led to the belief that no, the inflationary burst would prove transitory.
Yes.
But I think it's now recognised that, and it should have been recognised earlier, that simply making the assumption isn't good enough. You have to have some way, have to have some means of vindicating the assumption.
Yes. Yeah. In fact, Mervyn King went on to say at a Riksbank conference that that central banks, the exact quote, "We need models in which the credibility of a central bank is endogenous to its actions," and so on, right? And he didn't seem to be aware. This also seems to be an issue of all the work that has gone on doing that in the very early days at the Bank of Canada when we were developing the framework to do inflation targeting there. We recognized that long-term inflation expectations were much, much higher than what the target was, and that it was going to take time. So we built models with endogenous monetary policy credibility, starting, with the paper with Nicholas Ricketts and David Rose and I that looked at learning and policy credibility. You might want to go back. So we created this special web page just for Mervyn King, because he seemed to be completely unaware of all the work that went in to developing research and models with endogenous monetary policy credibility. So people that are interested in that work. We're also doing a workshop in Thailand and so on. Uh, you might want to check that out because one of the courses is going to be on these models with endogenous monetary policy credibility. And the nice thing about that is that now it's fully available in Diner Julia. So it's completely open source. So the first 3 days, we're going to be teaching people how do you do this correctly using the US as an example. So we're going to take people through what a mixed complementarity problem is for our monetary policy in the US, where you have an objective function for the Fed to compute the plausible path for the expected path of the Fed funds rate. Bob Tetlow, one of the senior guys at the Fed in a workshop at the National Bank of Georgia in November, said this is the state of the art. Absolutely. Many central banks they're still using Taylor rules, which are completely uninformative for this kind of work where you have to create scenarios that that are consistent with a far range of assumptions and so on. Second, it has a convex Phillips curve, which was obviously very helpful during COVID, because when one thinks about what determines convexity in the Phillips curve in the region of excess demand, it's the proportion of firms that are facing bottlenecks in the economy and so on. So it allows you to look at that. So it's a nonlinear model with endogenous policy credibility, and allows you to learn how to play around with the assumptions so that you can understand the implications of many of these concepts that economists use, like the output gap or the neutral interest rate or credibility. That all of these concepts are completely meaningless unless one understands what implications they have for how you tell a story. And so first 3 days are about that. And then, Martin, you'll be happy to hear this. Day 4 and 5 is going to be where things stand on our paper about how you incorporate like an FX intervention strategy on top. And so this obviously is not for big advanced economies. This is more for, how do you think about this as a small open economy, where if you're in a situation and you're hit by the effective lower bound, like say the Czech Republic was during the European debt crisis, how can you implement a very robust policy to eliminate any possibility of getting stuck in a low inflation trap? So what Lars Svensson called the foolproof approach to dealing with the liquidity trap and so on. So I just wanted to mention that if you're interested in learning about these models, they're now available in Diner Julia. We have a two-country example that's going to be talked about in the next issue of Oxford Economic Policy on the future state of macro. I wanted to ask, so you talked about Compass. I'm more interested is during your time at the MPC, like what were the models that were used then, and maybe you can talk about the issues, because the problem that you just identified with the Compass thing, right, is that it presumed that inflation always goes back to the target, or the assumptions that they employ when they use the model assumes that, because you said that at the end of the horizon they then assume that it's anchored to the target. And of course, in a forward-looking model, that would anchor things even today a bit, because today depends on tomorrow, tomorrow depends on the next day, that sort of thing. I thought what they did was even stranger than that. I thought what they did actually was that in each period that that they solve the model assuming that they're going to go to some reaction function in the next period. And when the next period arrives, when the interest rate's constant, so if for example, in those simulations that I showed you, where it was constant at 2%, okay, uh, I thought what they were doing was that they'd solve for the model in that period, assuming that in the next period, they'd go back to the reaction function and raise interest rates. But of course, for a constant interest rate path, they would then, in that period, assume it's constant, but then assume it's going to increase in the next period and stuff. And you seem to think that it was more at the end of their horizon and so on. So, you know,
No,
do you know
I,
between those two things?
I mean, I should say that I was talking. I think the main anchoring effect came from what happened beyond the end of the horizon, but and I never quite understood how despite asking questions, how the forecast was produced. No, combining no in a forward-looking model with the interest rate being constant, which wasn't the which certainly wasn't the endogenous path. I know I was referred to an approach developed in the Fed well, I'm not sure when it was developed, but I never quite understood what was going on. I think you may be correct in what you say.
Yeah. But okay, could you talk a little bit about um, your times, like when you were, on the MPC? What model was being used then? Or
Well,
maybe it
the
changed
answer,
or whatever.
no, the answer was mostly no model, and this is something that Bernanke refers to, that the forecast was always constructed by saying what happened in the previous forecast and what's changed over the last quarter. And of course, as I'm sure I wasn't the only person to say at the time, that begs an awful lot of questions. So, no, the perhaps because of the contortions that were needed over things like the fixed interest rate path, but I think the same thing happened with the market interest rate path, where the issue is that it's exogenous, not that no, the issue is that the path is exogenous for the forecast period, not that it's constant. And no, in both cases, models weren't used to produce the forecast, as far as I understood. The committee was sometimes shown simulations, and we didn't always find those terribly credible.
So how was the for okay. So would you say the forecast was owned by the MPC back then?
The the forecast was the MPC's, so in your sense of the word own, the MPC took responsibility for the forecasts of inflation, growth, and after Mark Carney arrived, unemployment. We hadn't produced a forecast for unemployment before, no, when Mervyn King was governor. The MPC took responsibility, but the underlying mechanism, and if you look at the what was the inflation report, now the monetary policy report, you can see that it shows tables of the evolution of other variables as projected by the staff, in a manner that was consistent with the MPC's forecast. The evolution of the other variables was produced by the staff, but the whole forecasting exercise, was done without the use of a model, as far as I could see.
Yeah, so this is very interesting
And
because
this is Bernanke criticised that. I mean, he certainly picked up on that point
yeah,
about the forecast being produced by saying what did we have last time and what's changed.
this is so interesting because you know when you listen to the testimony, by the chief economist Hugh Pill and stuff, and the questions are all about models and stuff like that, right? And the way he describes it, he blames it on the model. He blames it on the models because he says, "Look, we estimated these models over the last 30 years, and things have been anchored, and we just didn't question them enough." When he's asked that question, He's asked also a very good question. Do you mean to tell me that even though the Bank of England has been in existence for 300 years and we had this thing called the Great Inflation in the 1970s, that we've completely forgotten this because we're putting emphasis on these models. So the way he talks about it, it sounds pretty darn modelish. Uh, whereas what you're saying is that when you were there from what 2010 to 2016, is that correct?
Yes, that's right.
You're saying that there was basically no model. What about this Beckham thing? When did that thing come into effect?
That came into effect, I think, before the financial crisis, and I mean, it was a rather strange idea that people, optimized in the long run and did something different in the short run. It was well, I suppose a model that did show quite a lot of influence from David Hendry, and no, that was regarded as unsatisfactory. That wasn't, as far as I could make out, that wasn't in use when I joined the committee for producing the forecasts. And as I say, the mechanism that was used was this sort of almost rudderless process. What did we have in the forecast for the last quarter? How have things changed? And of course, for people new to the Monetary Policy Committee, that wasn't terribly useful because you hadn't been involved in the discussion about the history.
Okay. By the way, for people that are listening, what we're talking about right now is extremely important. Okay, like when I developed the framework at the Bank of Canada in the late 80s and 1990s, it started with sitting in this room. We called it was the Black Book room because the Bank of Canada every quarter would produce these projections and alternative scenarios. We used to call them case A, case B, actually, not what we mean by case A and case B in the prudent risk management approach, but and and there was so much knowledge that I acquired from just reading those black books through time, trying to understand how people were thinking about the economy. So it's what the methodology we call it today is the historical narrative approach to doing policy modeling, so that it's not just about specifying some equations and estimating them, but it's actually truly understanding the issues that people were struggling with at the time and how they were thinking about the. So someone should write history of of how this all worked at the Bank of England. I think what's going on here, especially because of this voting stuff, like sorry, the feeling that they have to own everything and vote on it, that has put them into a very difficult situation because if you try to do that with everything, like voting, thinking that you need to vote on all of these various assumptions, nine people can't do that. It just doesn't make any sense. And if you think that, you'll never make any progress whatsoever. What boards need to do is to hire the best economists you can produce. If you think about, how many economists you need today, given that we have AI and so on, and you think about a training program that takes young economists coming from school, like Susie, who's like our latest economist. If you think about how many people you need, it's not very many, as long as they're very well trained and so on. So I think central banks have become so inefficient. Well, these non-AFPass central banks have just become so inefficient because they're simply just not asking the right questions. You never start asking the right questions. You have no hope ever finding sensible answers and so on. So I just wanted to say that we have some interesting stuff coming out. We are creating a new nonprofit company with Kush Woodwa that is called AI-powered-learning.org. And it will allow people in countries that don't speak English, for example, or that might be 16 or 15, and just be interested in economics and math and English, and becoming one of the best of the best, having a dream to become one of the best economists in the world. So this will be look very much like ChatGPT and all the other large language models, but it will effectively be something that you can ask questions to. It will ask questions to you, and it will incorporate what we think is all the knowledge that an economist needs to know. Okay, you might think about it as, for example, understanding what would Milton Friedman say today in 2025 that he would, if he was rewriting his 1968 presidential address on the role of monetary policy. So how can we bring Milton Friedman and all of the greatest economists in the world into a contemporary setting and so on? So that's what this thing is. Now, how are we doing that? How are we designing it? We're obviously engaged with the best of the best economists that understand the history of economics and all those great papers, and working with a team of AI developers that are doing that. So there's also going to be a course in Thailand that's going to be taught about how to use AI in economics and finance. So we'll talk a little bit about where things stand in terms of developing, but it's coming. It's going to be probably available in a few months, and people are going to be able to. Uh, People like Susie are going to be able to try it out and so on. So, Martin, wise words again today. The jury's still out, but I think when Neeser, let me ask a little bit, because one last question on models. So we have kind of two extremes. So we have the David Hendry reduced form econometric stuff, and then we have the DSGE. We can see they can even suffer from similar kinds of problems. But in my paper that's going to be published in Oxford, we argue, at least for production models for monetary policy, that we should have semi-structural models that that incorporate things like endogenous monetary policy credibility, that tools for basically helping us to think about and to draw lines to tell stories with different scenarios and so on. So Neeser um, seemed they were into semi-structural models for a long time. Where do you stand on that? Because I developed one of the very first DSG models, but I would have never dreamt in my wildest imagination of using it as a production model for
No,
doing monetary policy.
no.
But
I mean,
where do you stand on those issues?
I think the answer is that no, what's now called the semi-structural model probably is the right way to go. The National Institute models don't have the same degree of institutional detail as the Federal Reserve Board, as Frobus does, but I think they're certainly part of the same family, and the reason they don't have as much detail is that the resources available to produce and maintain them are much more limited. But I must say, I think that that's probably the way, well, the general consensus seems to me that that's the way to go, or at least the Bernanke consensus was. And I think I'd agree with that. Now, thinking about later in the week, I can join you on Thursday, but I have to go at 9:45 because I'm off to Scotland.
Um, so no problem. We'll plan on that basis. Okay. So
Okay, well, thank
thanks,
you.
Sophie and Susie. Did you have any questions or comments or anything like that?
Yeah, actually, it was really interesting, like to understand the critics of why we actually vote if in like huger scale we are not having any certainties, etc. So it is becoming quite interesting. Maybe for the next meeting we would collect our questions because I have some questions, but I believe that it requires some researches.
Okay, good.
Okay, well, please do collect some
Yeah,
questions for meeting on Thursday.
okay, of course.
Perfect. Okay.
Okay, see
Enjoy
you on.
Thank
enjoy
you.
your day.
Bye.